During the previous week, Rupee posted sharp gains against the dollar, registering a low of 72.97 on Monday and a high of 72.3150 on Friday. Due to month-end dollar demand from importers and oil refiners, supported by modest intervention from RBI, Rupee fell toward 72.50 level on Friday, raising hopes that frequent intervention from RBI can be seen to protect the 72.50 level on a sustainable basis. Any rise beyond the above level may be temporary. Bolstered by steep gains in global stock markets and dollar's weakness against majors and emerging market currencies, the domestic currency gradually climbed higher during this week from the low of 75.32 on 22/4/2021 to the high of 72.3150 on Friday. Rupee has gained by close to 4% and recovered all the losses it suffered after the devastating effect of second wave of coronavirus on the local economy. The forex reserves of the country rose to reach 590.028 billion in the week ended 14th May 2021, close to an all-time high of 590.185 billion in the week ended 29/1/2021. As compared with the faster accretion in forex reserves in 2020, the increase in forex reserves in 2021 is much lower as the FDI, FPI and other capital inflows have slowed down. The forex reserves will be sufficient to cover more than 14 months of imports. The country's strong reserves position will also help to contain any sharp weakness in the rupee exchange rate arising out of any adverse external events which could lead to foreign fund outflows from the country. With the lockdowns being extended in many states, the domestic economy could take a hit, with the lockdowns expected to be extended till the first fortnight of June. Many of the economists smashed their GDP forecast to about 9% in FY 2022, while the negative growth in FY 2021 is maintained at close to 8%, with inflation fears in US toned down by the monetary authorities of the US stock indexes are rising, with the steep rise in global stocks, fall in the US dollar index, combined with lower dollar demand in the domestic market, extends the scope for a further rise in the rupee to test the 72.00 level. Positive sentiment on the rupee gates the market trend, and the absence of RBI intervention in the market widens the gap between the demand and supply of dollars in the market. In the current circumstances, frequent intervention from the central bank is required to halt the currency's one-way movement. We feel the rupee's strength will encourage the importers to defer the hedges, while the exporters may find the forward rupee levels attractive to sell their medium-term receivables. The positive sentiment on the rupee would gain momentum as the position mismatches widen to breach the resistance levels of the rupee, which we are currently witnessing. From the beginning of January 2021 till date, the Asian currencies has shown a modest appreciation or depreciation against the dollar. The appreciation is led by Taiwanese dollar by 2.68% and Chinese yuan by 2.40%. Thai baht registered a steep depreciation of 4.31%, followed by depreciation of 2.82% in Korean won against the dollar. Rupee gained by 0.75% in the referred period. The rise in Asian stocks is very steep, with Taiwanese weighted index rose by 14.37%, followed by KOSPI registering a huge gain of 11.05%. Most of the Asian stocks registered a rise between 5 to 8%, and the BSE Sensex rose by 7.25% in the above period. MSCI All Country Asia Pacific Index registered a rise of 5.10%. The rise in local stocks is supporting the local currency to rise on a gradual scale, breaching the various support levels on the way and now set to test the 72.00 strong resistance level anytime soon. Out of the forward dollar purchase position of RBI projected at over $45 billion, it is expected the central bank will extend their forthcoming maturities in May, which would impact on the forwards to rise up to 6-month maturities, with the rise in forwards more pronounced up to 3-month maturities. Even at the current spot level of 72.50 plus, we recommend the exporters to sell their 6-month receivables under the anticipated exposures category to derive a favorable forward exchange rate. Allowing the spot rupee to appreciate and the forward rupee to depreciate seems to be inappropriate, and the central bank has to announce the required measures to contain the rise in forward dollar premium levels across the maturities.